Tuesday, April 5th, 2022, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at how bonds have become the biggest financial scam going. We will also look briefly at the UK Treasury's announcement that they want the UK to be a hub for cryptocurrencies. That will segue well into the bond scam, so to speak. Back in the 70s, before central banks and governments started manipulating bond prices and consequently yields or interest rates, the market was relatively free, the market for bonds. And bonds, of course, are long-term loans, long-term borrowing by governments, corporations, whatever kind of institutions. We're going to look at the government bond market because it's the biggest one around, and especially US Treasuries, but this will apply to the major Western bond markets. So in the 70s, yes, interest rates were a lot higher. In 1981, the 10-year yield got up to over 16%. And usually the rule of thumb for a free market, if a government is issuing currency, fiat currency, and it's inflating that fiat currency, let's say by 3%, investors should demand at least 3% for their loans to the government, because they need to protect their capital. Because if it's diluted by 3% every year, they need at least 3% interest, not just for a return on their money, but also to neutralize the inflation, which is inflation. The analogy I'm going to give you here is if you buy normal milk and then you start noticing over the months or years that milk is becoming less and less tasty, and you realize that they're putting water in the milk. And that's what inflation is. Inflation is not prices going up. It's the government and the central bank diluting the currency. And yes, in the 70s, you did have negative real yields. There was a little bit of manipulation, but not as much, because bond investors were still quite awake. They were called the bond vigilantes. You also didn't have a lot of regulations. And it's ironic that these regulations are supposed to protect investors, and they're written by, of course, government agencies who, of course, especially in the last 20 years, have been completely captured by Wall Street. And why is that? Well, because Wall Street and the banks benefit from the inflation, from the dilution, because it means more business for them. And over the decades, these regulators, along with governments and Wall Street and fund managers, have forced institutions like pension funds, investment funds, to put a certain amount of people's savings, your 401k or your private pension in the UK, into bonds because they say it's a safe place to be. So whatever governments and regulators say that is safe to be is actually not safe to be, right? And so there's this forced pushing of people's savings into bonds, and that's why there's still a lot of money being put into bonds and stocks as well, for that matter. But back in the 70s, at least, people were awake to this, because if you had 5-6% CPI, what they call inflation, bond yields would be 7-8, and it would protect bond investors. But they even call bonds certificates of confiscation back in the 70s, when you had a lot of negative a long period of negative yields. So now, ever since '08, and in Japan it's been before that, governments, central banks, and for those people who say that central banks are independent, I think you need to wake up and smell the coffee, because they're working hand in hand, not just the central banks and governments, but Wall Street as well. So what's happened is that with QE, which is basically creating reserves, yes, it is money. In the central banking financial realm, it is called reserves, but it's as good as money, because central banks have been buying these bonds to keep interest rates low so that governments can keep borrowing. And up until recently, it worked fairly well, even though we've had real negative yields for a long time, ever since the '08 crisis. And the other thing I would say is that the measure of inflation, or what they call CPI, is completely doctored. It's been a lot higher. So the dilution has been a lot worse. So we've got the burglar really doing the statistics for robberies, and they're saying there's not that much robbery going on. And that's what happens when you allow government and the central banks to control the currency. You allow them to control the statistics, right? So now it's really unraveling. The milk is becoming less and less tasty. Pretty soon people are going to say this is not milk, and they won't want that milk anymore. And that's when currency collapse takes place. They don't want the milk anymore. They realize it's not milk, it's just water, or something even worse. And why is that? Well, because they're seeing the rate of inflation. Really, the official rate is around 7 or 8 for all the major Western countries. And despite that, we have interest rates near zero still. Central banks still have their policy rates near zero. Yes, the 10-year yield has risen from 1.5 in the US to around 2.5 now. But if you look at the UK, for example, our 10-year yield is still like around 1.5. You look at Italy, you look at Germany, even Germany now, their CPI is like almost 8%. So yes, another analogy, what's happening now to investors? Because the currency, of course, affects the whole of society, because you're giving it your best, you're working, you're producing, and you're supposed to be getting good milk, and you're realizing the milk is bad. But for investors, the analogy would be you put gasoline or petrol or diesel in your car, and every night the government goons come and siphon off some of the fuel from your car. And they've been doing that, well, for eons, for thousands of years. Governments always cheat, but recently they've been siphoning off a lot, and people are noticing it. So you park your car in the evening when you come home from work, you got half a tank, and then in the morning you go into your car to go to work, and it's only got like a quarter of a tank, and you're saying, what's going on here? And here I bring another analogy of gold. Gold being sound money, gold being a barometer of monetary rectitude. Gold would be, in the past, of course, because we don't have it anymore, gold would be the CCTV camera in your garage or in your house, focused on your car, so you can see who's siphoning off the fuel or the money, or inflating the money. And government has, of course, smashed your CCTV camera. They don't allow CCTV cameras anymore. And so you can't protect yourself. And that's why governments, especially in the West, hate gold and silver. They would never go back to an honest system voluntarily. It would have to be because of a huge crisis. It would have to be for necessity, for survival. And even then, I wouldn't trust them. Can we trust the Russians with their new system, or the Chinese if they bring a new system? Probably not. The Chinese and Russian people probably need to keep a close eye on their leaders, supposed leaders, or central banks. But it will be probably better than what we have now. And it's weird because you might want to say what's happening now in the world geopolitically is by accident, but it could also be engineered to wean off, let's say, the BRICS countries from this scam of a monetary system, because you need to understand that a lot of countries, when they accumulate foreign exchange reserves, and we saw yesterday that the coffer data. What's the coffer data? Well, it's the composition of foreign exchange reserves published by the IMF. We saw that the share of coffer of the US dollars dropped to around 58.8. It used to be 70, above 70%, maybe 2 decades ago. Yes, it's gradually dropping. What you need to realize is that sovereign countries that accumulate a lot of reserves, they buy bonds to park their reserves with the US or maybe with Europe. And they're realizing as well that they've been cheated. They're getting their limousine siphoned off. And that's why I think, you might want to speculate what's really happening. But the result is that a lot of countries now, they want out of this scam. They realize they're getting this supposed milk, and it's diluted, and then they put it in their limousines, their diplomatic limousines, and it's getting siphoned off. So they want a system that's more honest. And of course, gold is that system where you got the CCTV camera. Of course, the West hates that. But as I said, a crisis will force them into it. So if you look at the BRICS countries, the countries that are not in the club, so to speak, Pastor Lindsey Williams talked about Jonathan May, who told him about how the major Western countries really run a club, a currency club, where they keep their currency strong and manipulated, and that's via the bond market, while the other countries don't get that same treatment. You look at Brazil and other countries, their interest rates are like 10, even above 10%, because they don't get this special dilution. It's not fair just for governments and countries. It's not fair for the general public either. So what I think is going to happen, and it's a real shame, because a lot of these investment funds, pension funds, private pensions, like corporate special places where you put your savings, they're forced to buy into the bond market. Yes, they can manipulate bond prices higher, and they have. But what will happen eventually is when the currency collapses, when people realize it's just water, yes, you might have your treasuries or your gilts being valued quite highly in that fiat currency. But if the fiat currency is worthless, is your bond going to be worth anything? So that's why I wouldn't put a penny in the bond market. Any bond market, not just government, but corporate, Because the other thing that will happen eventually is that bond prices will drop because people are going to realize it's a scam and they're going to sell. And when you sell, the price drops. When there's a lot of potential sellers, the prices drop and yields go up. And yes, and again, we go back to the rebalancing. And this is just beginning. We're going to rebalance into hard assets. And why is that? Well, because hard assets are real things. The bond bubble is just an illusion. And with that, I'm going to quickly go into this headline or story that came out yesterday. And hopefully, after hearing what I told you about the bond market and what central banks and governments do, you realize that this too is a big Trojan horse. So Rishi Sunak, our Chancellor of the Exchequer, announced UK unveils bid to become global hub for crypto. Government measures to attract digital asset companies include stablecoin regulation and Royal Mint NFT. As I said, it's a Trojan horse. The objective or the raison d'etre of cryptocurrencies was a decentralized, unregulated, free market system. So do you really think the UK government is going to make sure that that kind of environment remains? Of course not. What about the Royal Mint? Well, the only thing I trust about the Royal Mint is the gold and silver coins that they mint. They are good coins, but other than that, I wouldn't trust them with a barge pole. I wouldn't trust the UK Treasury with the barge pole. They're the people who've been diluting your milk. They're the people who've been siphoning off the fuel from your car. And why would you want to trust what they want to do vis-a-vis cryptocurrencies? So with that, let's quickly look at where the markets are this morning. It's 20 to 9 a.m. London time, or 8:40 London time. We've got spot gold at 1928. It's down $4. High's been 1937, low 1926. So maybe now you understand why the bullion banks and governments, treasuries, need to try to keep a hold, try to keep a control of the gold price, because you don't want the CCTV camera back on, but it will come back on, and then that's when everything will unravel, and that's why you need to be patient. Maybe if you're not patient, gold and silver are not for you. But anyway, spot silver is up 14 cents or 0.5%, 24.66. High's been 74, low 42. The Dow futures up 25 points. The NASDAQ is up 26, and the S&P is up 0.1% or 5 points. So markets slightly higher this morning. FTSE is down 11 points at 75.59, and the Euro Stoxx 50 is up 15 points or 1/3%. To the fiat currencies, and the currencies are basically a representation. They're backed by these bonds, right? So that's what you need to understand as well. Yeah, the other side of the debt is the currency. And if the debt is no good, the currencies are no good. So right now, sterling is up 0.1% at 131.28. The euro is up 1/8 at 109.83. The dollar's up slightly versus the yen at 122.90. Dollar's down about 0.15% versus the yuan at 636.50. Dollar's unchanged versus the Swiss franc, 92.55. Aussie dollar is quite strong, is up over 1%, 76.30. I saw a headline that the RBA, the Reserve Bank of Australia, is hinting at raising rates. So maybe that's what's driven the Aussie dollar. The dollar is down 0.2 versus the Canadian dollar at 124.58. And the Kiwi dollar is up about 0.75%, just below 70. To the general commodities, WTI crude is back above 100. We're at 103.40. I think we were below 100 yesterday, even at 98. So it's rebounded quite sharply. We're up 1% overnight. Brent crude is up 1% as well at 108.15. High-grade copper, pretty strong as well, near the all-time highs here, up 1.3% at 484. US nat gas up 2.3% at 587. To finish off, I'm going to look at the US Treasury market. The 10-year yield right now is up almost 3 basis points, around 244. The 2-year is at 246. It's up 3 basis points. So the 2s10s are inverted still. And as I've been saying, it's a bad sign for the economy. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.